So before working out any of these problems, okay, first you need to get few numbers, then only you can get the answer. So first we have to find out things like S cube, right? We need to find S cube, then SP, then A cube, and AP. Okay, so we need to find out these numbers. So okay, I think we have set up the table. So here onwards it's just like finding out the applying the numbers. So first we'll move on to the question. So he says calculate all appropriate cost and sales variance. Okay, so you have to work out all the variances. The marks is not given, so we'll assume that we have to work out almost all the ratios which are possible to do. Okay, so we'll start. So the question in standard costing will always give you two sets of data. One is standard data and the other one is an actual data. It gives you two sets of data. So if you see here, we'll read the question. Omaha manufactures a standard coffee table. The standard cost card appears as follows. Okay, so look here, the standard cost card means it's a standard cost. All this is standard cost. Okay, so material is 25 meters at $0.5. Labor is 2 hours at $2. Variable overhead 2 hours at $1. Fixed overhead 2 hours at $1. Okay, so selling price they have given. That's a standard selling price, and standard profit is also given. Every number is given hopefully. So thereafter, see, budgeted output and sales were 2000 tables for week 2. So we are doing the sum only for a single week. Okay, and they thought of selling 2000 tables, and let's see what happens in the actual data. So we also have the actual data here. So it tells you about production cost. There are like 1800 tables. So this is what they have actually produced. So materials is 54,000 meters at 0.45. Labor is 3,500 hours worked, and variable overhead is they have given it as a whole number, and fixed overhead also they have given, and total production cost, okay, 1800 tables is this number. So this is what they have totally produced. So there's a difference between the is there a difference between the production and the sales? No, both are like 1800 only. Whatever is produced, it is they sold. No, there is a 200 inventory, closing inventory. So the total sales has been only, so the total sales has been 1600 tables. Okay, so that's about the data, and they've also given the profit. Okay, so with this we have to compute the ratios here. So this is what we need in sales variance. First we'll find out what the standard quantity, how much of units they wanted to sell. They wanted to sell 2000 units, but they actually sold 1600 units. Okay, the next one is standard price. At what price they thought of selling it? See, per unit they wanted to sell at 25. At what price did they sell? At what price did they sell? See, they have sold at this number, 46,200 on 1600 tables. So it's not given directly, so we have to find out it. 46,200 divided by 1600. So the value you get here should be similar to the 25. It should not be way different. See, so their actual price is like is way higher. Okay, so that's about AP. And what is about the SM, standard margin? Okay, the standard margin is 3.5. But how do we know that? See, the question here, you are working in terms of standard costing absorption. So I'll put it here also. So standard margin is going to be standard profit per unit. So that number is going to be this one, 3.5, right? So we have done till that. So now we have to work out the ratios. Okay, so the ratios are, so we already have it here, so we can work out directly here. We need AQ, which is 1600, into SP minus AP. So SP is 25 and AP is 28.875. Next one is SM, standard margin, which is 3.5, into SQ, so standard quantity minus actual quantity, so now solve it. So look logically and then put whether it's a good variance or a bad variance. Okay, they should have sold the item. Okay, they should have sold the item at 25, but they have sold at 28.8. Okay, it's a good thing. So we can put it as a favorable variance. Okay, I'll put it as FAV, favorable variance. It's a favorable variance. And look at here, they should have sold 2000 units, which is a standard, but they sold only 1600. So that is a bad thing, which is called as adverse. So that's about this concept. So we'll move on to the next one. So the next one is a cost variances from here on. So it is about material variances. So we have to get these data, then only we can work out the sum. So what is the data that we need? We'll just pull the question as per how we need it. Okay, done. So we need standard quantity, actual quantity, standard price, and actual price. All these things are only for material sake. Okay, so the most easiest number is SPAP. So first we'll get that. Okay, SP is standard price of the material. So what is the standard price of the material? Is it this number or this number? See, the standard material per meter is what we want. Okay, so the number is going to be 0.5. Why? Because it is $1 per meter. That is what we are bothered about. Even in actual price, that is what we want. Okay, and each unit will take 25 meters. Okay, each unit will take 25 meters. We'll just like have it till there. So what is about the actual? Actually, the company has consumed 54,000 of meters. So 54,000 of meters the company has consumed. Okay, now what's the actual price? The actual price is 0.45. So that is also like very clear. We got all these numbers very clearly, but only number we couldn't get is the standard quantity. See, standard quantity is a very different one. Okay, because he has given only for one unit will take 25 meters, but how much did they produce actually? Okay, you should not multiply 25 meters into the budgeted production. If you do that, that doesn't work. You have to multiply the budgeted per unit into the actual quantity. Then only it becomes the flexible budgeting. So multiply the standard quantity per unit into the total actual products produced, that is 1800 tables. Okay, so I have given this concept here. See here, standard quantity per unit is the standard material divided by budgeted units. Okay, and standard quantity equals to actual units into square meter. Okay, this is what the concept is. Okay, actual units into produced into standard quantity per unit. You have to multiply that. So per unit it is 25 meters. How many units did we produce? we produced 1800, which is the actual. So multiply this, then only you'll get the answer. Okay, so let's get that answer. So that answer comes to 45,000 meters. See, from here on it is like quite simple. You can just multiply it and get the number. So first we'll do cost variance. So SP into SQ. SP is 0.5 into SQ, which is 45,000 meters, and AP into AQ. AP is 0.45 into 54,000 meters. So we'll still work out the other ones, and we'll just then we'll move. Again, what is AQ? 54,000 meters into SP minus AP. SP is 0.5 minus 0.45. Close it. Usage, it is SP into SQ minus AQ. So SQ is 45,000 units minus 54,000, sorry, meters. It's not units, it's meters. So done. We can find out the answer for these. Now look at this. Which one seems to be higher? Okay, so multiply this and see, it comes to 22,500, and if you multiply this, you'll get another number. Okay, so individually calculate each of them, you will find out whether it's a adverse or favorable. Better than that, look at the next ratio, you'll get a better idea. They should have bought this item at 0.5, they have bought at 0.45. Okay, so that is a good thing. So it is a favorable variance. They should have consumed 45,000 meters, but they have consumed 54,000 meters, which is adverse. Okay, so if a minus is adverse in these variances, here also it is adverse. Do not confuse yourself with this minus plus and this minus plus. Okay, always look at the logic of it and then work it out. Okay, so this is about income variance, so it will be opposite to what we compute in the cost variances. Okay, so be careful with that. If you get the adverse favorable numbers meaning wrong, then you will lose marks. So we also told you that the cost variance can also be found out in this formula, right? So cost variance equals to price plus usage. We told you it can also be found out like that. So let's check whether that is also correct. See here, we have 2,700, which is favorable. Okay, plus is a normal symbol there. We have minus 4,500, so that you put it in bracket. So get the answer. It should come to minus 800. So let's see whether you get yes. Okay, so you don't need to put this, it's just for a checking purpose, so we don't need to put this and try to find it out. Okay, so that's about the concept here. We'll move on to the next one. So as material is there, see, material is there and material has a closing stock. Okay, so closing stock is there. So closing stock valuation is very simple. Closing stock is the standard quantity. Okay, so the actual quantity closing stock into standard price. It should be in standard price. So the formula would be, how many units are closing? 200 units are still pending, into what is the standard price I think this closing inventory is for the total product. Okay, so I think this we'll leave. Okay, it's not material. I think it's not material, so that we'll leave. We'll move on to the next one. See, so the next one is labor. Okay, so labor, again we need these numbers: actual, okay, standard hours, actual hours, standard rate, actual rate. So 4 things we need here. And we have 3 formulas here: total, rate and efficiency, and one is a proof. Okay, one is just a proof here. So first we will find out these and get the answer. So labor per unit, it is 2 hours. To do 1 unit, it is 2 hours. Actual hours worked is here. They worked for 3,500 hours. Okay, you can put that here. What is the standard rate? The standard rate is 2. It is $2 per hour. You can put it like that. The actual rate is, it's not given fully, it's not given correctly. It says 3,500 hours worked and the amount is 7630. So you have to compute it. There's no other way. So we'll compute like this. So 7630 divided by 3,500. Okay, it is 2.18 per hour. Okay, that's what is paid. So let's get the answer here. It's like very quick and easy we can get. So okay, and I think we have not finished with standard hours. Okay, standard hours, 1 unit will take 2 hours. How many units did we produce? We produced 1,800 products. So it should have taken 3,600 hours. Okay, so whether you compute it is similar or not, you can correct or not, you can find it out like this. These numbers should be similar: 3,600, 3,500. It should be like little bit similar. Here also it should be similar. See, 2 and 2.18 are like little bit similar. Okay, so we got these numbers. Now we will find out the formulas for it and we can get the answer. So SR is 2, SH is 3,600, and again AR is 2.18 into AH is 3,500. We'll work out all the ratios, then we'll compute the answer. AH is 3,500. SR is 2. AR is 2.18. Again, SR is 2. SH is 3,600. AH is 3,500. Okay, so again look at this variance. It says you should have paid $2, but you have paid $2.18. So that is actually bad, right? So it is adverse. So minus is adverse, so plus is favorable. See, okay, so add both, you will get the answer. If you add both of these, you will get the answer. We'll just like check it for proof. See here, so it's going to be minus 630 and add the 200. Okay, it has added here itself. So it's 430. So 430, see, all minus symbols are adverse, because in all the cost variances, minuses are adverse and plus are favorable. Only in income variance it is opposite. Okay, so hope you got the idea here about the labor variances. Now we'll move on to the variable overhead variance. So variable overhead variance is like quite easy to compute, because the value will change. The standard hour and actual hour will always go along with the standard hour and actual hour in labor variance. So we don't need to compute anything newly. Okay, standard hour and actual hour you can just copy it from labor variance. The rate alone will change, so that alone you have to find out separately. Okay, so we'll start with what's the standard rate. So the standard rate, if you see, that's clearly given. Okay, that's clearly given. It is $1 per hour. So here also you could see variable hours also is 2 hours per unit. Labor is also 2 hours per unit, and variable overhead is also 2 hours per unit. Okay, so only if this differs, you have to again compute it. Sometimes they will never give this at all. This 2 hours they will never give. If they don't give, the assumption is whatever the standard labor hour is there, the same is applicable for the variable overhead hours. In case the number changes, okay, in some questions the number changes, in that case you have to compute. Okay, because in that case you have to assume that it's going to be like 1 hour, 1 variable hour, so you have to put 1 into 1800. Okay, and see here also in variable overhead they have not given how many hours worked. They have told you how many materials is consumed, how much hours is consumed, labor hours, but they have not told you what is the labor hours, variable overhead hours. They have not given. Why? Because the assumption is the labor and variable overhead are like same. Okay, so that's why we have copied, or else we have to work it out again. What is the actual rate? So actual rate is 3440 divided by 3500. Okay, so we have to work out it here. So it's going to be 3440 divided by 3500. So this is a number. So let's work out everything. We need SR, SR we need, right? SR is 1 into SH AR actually after decimal you can take like 3 numbers, that's more than enough, but we'll get the right answer, because like sometimes they would have taken all the numbers. So AR into AH is 3500 hours, again AH SR minus AR. SR into SH minus AH. So almost all are good, variables are favorable, because see, they should have worked for 3000. If you take efficiency, they should have worked for 3600 hours, but they have worked in 3500 hours itself. So that is like favorable. So all the plus are now favorable. Okay. So if you add these both, again you will get this one. So I think that is also clear. We don't need to work out it again and show you proof. That we'll skip. And the final one is fixed overhead variance. Okay, fixed overhead variance. So we have to find out cost, expenditure, volume, capacity, and efficiency. So we need these numbers first, then only we can find out these numbers and finally the variances. So unless we find out these, we can't work out the problem. So proof we'll show you later, that won't be much of a problem. So the first one that we have to get is budgeted units. Okay, first we have to get that. So budgeted units would be, we have to search. Here it is. Budgeted units, they thought of producing 2000 units into standard rate per unit. Okay, what is the standard rate? Only the standard fixed cost rate. Okay, so if you see this problem, the fixed cost hours is 2 hours and rate is 1.5. Okay, so the standard rate is 1.5. So we got that. Let's go to the actual units produced is 1800. So we get it from here into actual rate per unit. Actual rate per unit, fixed cost, are we getting it anywhere? Okay, see, we don't actually need to find out this at all. Okay, we don't need to multiply this at all because the number is actually given. The actual fixed overhead is 6325. So we don't even need to compute this. We got the answer directly itself, 6325. So the next one is recovered. So recovered tells you budgeted overhead. Okay, budgeted means like this is the budgeted. So unless you get the answer for this, we cannot find out the recovered. So that is 3000. So the formula is, I think we'll work out here. We'll work out it here itself because we don't have space there. 3000, that's a budgeted fixed overhead, divided by, okay, I think we have to first find out this answer. Okay, 3000 divided by budgeted units. How many units are produced? 2000 units were produced. Close the bracket. Then multiply actuals in units. Okay, how many units you have actually produced? You have produced 1800 units. Okay, so get the answer for that. Okay, I think we did something wrong here. Wait, see, the fixed overhead rate is not 2, is not 1.5. 1.5 is for per unit. Okay, to make 1 unit it will cost $3. Okay, so it is not 2, it would be $3. So how did I find that it is wrong? Because see, when the actual is 6300, the budget will not be 3000 and all. It cannot be 3000 and all. It is like very off the mark. So you can see, even though I made a mistake, I could rectify it because I can get the logic of it, because the numbers should be similar only. Okay, so this number should be budgeted overhead is 6000, not 3000. So we'll get this. So this answer also should be similar to 6000 or around 6000 it should be. Okay, 5400 is okay, that's not a problem here, that won't be a problem. So the next one is again, see, the next one is budgeted overhead, so that is 6000. Budgeted hours, okay, budgeted hours, so budgeted hours is 2000 units are there, and each unit will take how many hours? As per budget, it will take 2 hours. To take 2 hours. Actual is 1800, and how many hours it takes? into actual hours we have to put. Actual hours is not at all available here. Okay, as actual hours is not available, we'll better take the labor hours itself, because there's no other fixed hours available. Fixed hours is not there, fixed overhead hours is not there. So we'll take labor hours, because labor hours and variable overhead hours are like same. Fixed overhead is also like same. See here also you see labor is 2 hours, variable is 2 hours, fixed is also 2 hours. So they're all equal. So here also it should be equal. So 3500 here for labor, for variable and fixed overhead. So what we'll do, we'll take that. So that comes to 3500 hours. So first our answer should be solving this. Okay, first it is going to be 2000 into 4000 and 6000 divided by 4000. So we'll get 1.5. 1.5 into 3500. So that too should be the answer. Okay, so 3500 into 1.5 will give you, I think, 5250. Let's see the answer. Right, 5250. So now we got the basic numbers. We have to put these numbers here and thereafter get an answer. So first we'll find out. So first we'll find out R. R is 5400 minus A is 6325. B is 6000 minus A is 6325. Volume is R minus B. R is again 5400 minus B. B is 6000. Next one is S. S is 5250 minus B is 6000. So again efficiency is R 5400 minus S, standard is 5250. Okay, see, almost all variances are negative, so they are adverse. Mostly they are adverse. So they are adverse for all these. And they are favorable here. Okay, so we'll work out the proof also, whether what we have done is correct or not. We can find out through proof. So proof is cost variance is equal to expenditure plus volume. So expenditure is 1 minus 325 plus again a minus. I'm not sure whether it will work. So add that, and volume is minus 600. So minus 925 is cost is minus 925. Yes, it is a minus 925. And what about volume variance? So volume variance is equal to capacity and efficiency. Capacity is 1 minus 750 plus efficiency is 150. So our answer should be minus 600. Both, if you take, are adverse, and check. Okay, so both are minus 925 and minus 600. So volume is minus 600. Are we correct? Yes. So that's about the concept here. We have worked out almost all the variances. The only difference is we have worked out in terms of absorption costing. For marginal costing, it differs. So marginal costing we will see in the next problem.